So, on January 23rd, the financial markets seemed pretty calm. Almost too calm, you know? Because behind the scenes, a massive storm was brewing in the currency markets, one that might just signal a huge shift in the entire global economy. Let's get right into it. All right, so picture this. The day starts, and $1 gets you 157.50 Japanese yen. Pretty standard, right? A strong dollar. Business as usual. Nothing to see here. And then, bam, the bottom just drops out. All of a sudden, the dollar takes a nosedive against the yen, falling almost 2 full yen to just 155.60. Now, for those who don't follow currency trading, a move that big is like a magnitude 8 earthquake. It is a huge deal. And here's the craziest part. This wasn't a slow burn over days or weeks. Nope. This entire collapse happened in just a few hours. The speed of it was absolutely breathtaking and sent shockwaves through trading floors all over the world. Okay, so this is the multi-trillion-dollar question that everyone was asking. What in the world could trigger such a violent move in one of the planet's most traded currency pairs? Well, the culprit wasn't some big market crash or a breaking political scandal. It was something way more subtle, but maybe even more powerful. It was a move by the New York Federal Reserve. Think of it like a warning shot fired across the bow of the global markets. The official name for this is a rate check. And it sounds so harmless, doesn't it? The Fed just calls up a few big banks and casually asks, hey, what's the dollar-yen trading at right now? But in the high-stakes chess game of global finance, that's not just a question. It's a powerful signal that says, we're watching, we're concerned, and we are ready to make a move. And this is it's genius, really. It's pure psychology. The Fed doesn't actually have to spend a single cent buying or selling currency. Just by picking up the phone, they completely change the game. Every trader on the planet now knows the central bank is paying attention, and it forces them to rethink any bets they had against the yen. The threat of action can be way more powerful than the action itself. Now, a rate check is interesting all on its own. But the real story, the thing that makes this a potentially historic event, is who did it. Okay, this is where it gets really, really interesting. For years, the story has been the same. The yen gets too weak, and Japan has to jump in all by itself to defend it, all while the U.S. was officially committed to its strong dollar policy. But not this time. This time, it was the New York Fed that made the call. This could be a signal of a massive pivot in policy. It suggests the U.S. might now be working with Japan to weaken the dollar. That is a huge, huge shift. And Japan wasted no time backing this up. With a big election coming up on February 8th, Prime Minister Sanae Takaichi came out with a very direct warning to anyone betting against the yen. The timing wasn't a coincidence. The message was loud and clear. The party's over for the falling yen. A bombshell like this in the currency market never, ever happens in a bubble. It's going to send ripples everywhere. So let's take a look at how it shook up everything else. The U.S. stock market's reaction was, well, kind of confused. The Dow, which is full of big industrial companies, went down. But the NASDAQ, which is heavy on tech stocks, actually ended the day a little bit higher. You see this kind of split when investors honestly have no idea what to make of the news. But don't let that calm surface fool you. Underneath, fear was absolutely on the rise. The VIX index, the market's fear gauge, jumped almost 3%. So even though stock prices weren't crashing, you can bet traders were getting nervous and preparing for some serious turbulence. And what happens when investors get scared? They run for safety. And that is exactly what we saw happen in precious metals. The price of silver shot up over 7% in one day. That is a massive jump, and it's a textbook sign of investors fleeing to what they see as a safe haven. So let's recap. We've got a historic move in the currency markets, a spike in fear, and a big rush into safe assets. That's what happened. Now we get to the most important part. What does any of this mean for you and your money? To try and answer that, we're going to walk through a few potential game plans, breaking them down based on different appetites for risk, from conservative all the way to aggressive. All right, first up, if your main goal is protecting what you have, the market is sending a really clear signal here. It's time to dial down the risk. For starters, that means getting out of any trades that bet on the yen getting weaker, like right now. It also probably means raising your cash levels and maybe even hedging any stocks you own of big Japanese exporters, since they could get hit by a stronger yen. Now, if you're somewhere in the middle, this is a moment to rebalance and reevaluate. It means it's probably smart to cut back on those risky yen trades, maybe by half or so. It could also be a good time to look at your portfolio and think about shifting some profits from those high-flying tech stocks over to more stable, value-oriented companies. And most importantly, have a plan ready so you can jump on any buying opportunities if this uncertainty causes a dip. Okay, but what if you're the kind of investor who sees all this volatility not as a threat, but as an opportunity? Well, this event just opened up some brand new plays. You could make a direct bet that the yen is going to keep getting stronger, or you could even use options to trade the rise in volatility itself. But, and this is crucial, the key to this approach is discipline. You've got to use strict stop losses to make sure a smart, tactical bet doesn't blow up in your face. Look, the most important thing right now is to have a plan. You want to move from reacting emotionally to acting strategically. Think of this table as your playbook for the next few weeks. It takes the panic and the guesswork out of the equation. It's just a simple, if this happens, then I do this, game plan. And all of this brings us to the biggest question of all. Was this whole rate check thing just a temporary shakeup, a one-off event? Or did we just witness the first shot in a new kind of currency war? The shot that might signal the beginning of the end for America's long-held strong dollar policy. Because if that's what's happening, then the ripples we saw on January 23rd, they were just the start of a much, much bigger tidal wave. Definitely something to think about.